So what I'm going to talk about today is the mortgage meltdown and a few issues involving the mortgage meltdown. And I'm not sure what the timing on this is going to be like, so I'm going to go through a bunch of things relatively quickly. Do you want to turn down the light, please, just so we can see? So this is actually, let's see if I can do this right. So there's a lot of material here. What I'm not going to talk about is about how the breakdown of the real estate market affected the securities market. That's a piece of this that, there's lots been written, lots of courses are covering and that sort of thing. So that really won't be part of this. I'm going to stick pretty much with loans and housing and real estate. So just a couple tidbits of data. So from June 2006 to August 2010, housing prices on average declined by 28%. That's pretty huge. 1 out of every 4 homes with a mortgage is underwater. Okay, by underwater, what I mean is that the amount of the mortgage is greater than the value of the home, and that homes in foreclosure have gone up by a factor of 5. It's still not the majority of homes. It's not even a huge proportion of homes, but that's a huge increase. Foreclosure is, really the death of a loan, the death of a borrower almost in terms of credit ranking and in terms of their home. So what I want to do is talk a little bit about defaults, what caused the problem, and a little bit some implications of that. So one thing to think about, there's been a lot of literature about mortgage loans and why people default. And typically we think of a mortgage loan as a put option. Basically, you can, because up until fairly recently, lenders don't go after the mortgagor for personal liability, just because it's so hard. The transactions costs are so great, and frequently the debtor is going to be judgment proof. So frequently we don't go after them. So then basically what it is you take a loan, and if you can't repay it or don't want to repay it for some reason, what you do is you put the property to the bank or to the ultimate investor in the mortgages. And it frequently is called ruthless default. Ruthless default is any time your loan is greater than the value of your property, under this economic theory, you should default and just put the mortgage. But of course, people don't do that. The market is sticky. There's reputational consequences. In addition, what we typically see, then there's attachment to one's home, which isn't marketized. So what we typically see is there's trigger events. Why do people default? Something happens in their life that causes them to no longer want to live there or no longer be able to afford to live there. Frequently it's unemployment, health events, or changes in the cost structure of the loan. This is pretty new, and by this I mean resets. So for many loans, the large majority of loans in the past decade have had this provision where there are adjustable rates. So when the adjustment goes way up and you can't afford it anymore, then you might choose to default, or you may have no choice but to default, or it just becomes almost, it seems like there's no choice. So what I wanted to talk a little bit about is what led to the mortgage meltdown. So let's start with the idea that home ownership is basically almost gospel. It's almost a religion in the United States, which it isn't in every country around the world, but it is here. We have been trying to expand home ownership ever since the end of World War II, and we've been incredibly successful. During the past decade, home ownership went up to an all-time record of 69%, and where the great expansion was happening was in the working class and the lower working class. And so we saw just tremendous increase in home ownership. And that's part of the problem, or at least arguably part of the problem. We see it in lots of ways, and indeed in property or in tax, you see this. One is through the tax law. We allowed deductions for mortgage interest. Used to be you got to deduct all of your interest for everything. Then in 1986, it was just mortgage interest. So what did that do? That encouraged people to pile up all of their debt secured by the most important asset they had, which was their home. Arguably, this might not have been a good idea in retrospect. Also, we don't tax imputed rental income. So basically, you can be thought of, if you're a homeowner, as renting a house to yourself. If you were renting it from someone else, the landlord would have to pay tax on it, but because you live in the house as a homeowner, you don't have to pay tax on that. That encourages capital to flow to homeownership sector. You have the Community Reinvestment Act and the GSE rules. Fannie Mae and Freddie Mac, which I'll talk about later, are called GSEs. And basically what these rules did was they said there are social programs or social objectives that we're trying to achieve, such as increasing the rate of home ownership among low and moderate income folks, raising the level of home ownership among racial minorities. And so what these laws did was they implicitly, pretty explicitly in some ways, encouraged banking institutions to make loans to more marginal borrowers. And there's a big debate about how much this affected the mortgage meltdown. Generally, what we see is it's only a small effect. So where you see this politicized is people to the right are making the argument that these laws, which they never liked, the political right, they never liked these laws, and that basically what they did is, because of this regulation, which caused risky people to buy or made available loans to risky people, or encouraged the secondary market to make loans available, we ended up with these large defaults. It turns out that I actually think there's a piece of the puzzle that actually is this, but I think it's a much more complicated story. I think it was part of a generalized reduction in quality of loans, and I think that this led the way to that, but it certainly wasn't the major cause of it. You also had historically low rates, right? This was the story that we're all hearing, that the Fed kept interest rates too low following the dot-com crash for too long, and so you had cheap money going after housing. People were investing where they shouldn't have invested because the interest rate was so low. And you have, after the dot-com bust, you had stocks were not doing that well. And so what people did was they pulled their money out of that type of investment, and instead what they did is they bought homes, which were appreciating rapidly. And you see all of these supply factors and demand factors are pushing on homes as values, and you saw this tremendous increase in price, which I'm going to show you on a graph shortly. You also had, and this is where the story gets a bit complicated, you had the secondary mortgage market. So I'm going to jump ahead, and I hope I can get back. So the secondary mortgage market, Fannie Mae and Freddie Mac. Does everybody know what Fannie Mae and Freddie Mac are? Who doesn't know? Actually, who knows? That's a better way of doing it. Okay, so basically, Freddie Mac and Fannie Mae are government-sponsored enterprises, and essentially, they were privately owned, and they were there. They had special relationships with the federal government, but they had stockholders. And you'll see this was part of the problem. Initially, they existed coming out of the Great Depression, and the goal of Fannie Mae and Freddie Mac was to ensure liquidity in mortgage markets. So back, those of you who've watched It's a Wonderful Life, that used to be the way that mortgage loans were made in this country. A bank, so let's say Chase Bank, would make a loan, and then it would hold on to that loan until it matured. So it's pretty simple. The problem with that is it only had the amount of money to lend that its depositors gave it. So there was liquidity problems because you had fast-growing parts of the country, typically in the West, and slow parts of slow-growing parts of the country, typically in the East. And so you had this mismatch. And so you had high interest rates where you had high demand, and low interest rates where you had low demand. And that didn't make any sense. So what we wanted was a smoothing out. So Fannie Mae and Freddie Mac were created along with Ginnie Mae, and essentially what they did is they bought loans from one part of the country where there was high demand for real estate, and they sold them to other places. So essentially what they did is they created a market, or a secondary market, meaning the origination market's the first market. So Chase would then make a loan, and then they would sell the loan to Fannie Mae. And it was wonderful. So when I started teaching, I wrote my tenure article about this, and so that was a while ago. This was still pretty new, the growth of the secondary mortgage market. And I was, if you go back and read it, I probably want to, put my hand over my head for a moment. Just shows you times have changed. But, people were all, like Fannie Mae and Freddie Mac, they're the greatest things in the entire world. Now, of course, they were also paying off politicians and giving grants to the research community. But that's a different problem, which we will talk about. So it actually dropped interest rates by a quarter point, which actually made a big deal and really created liquidity for the rest of the country. What it also did was create a huge principal agent problem. And it got worse and it got worse. Initially, it wasn't so much of a problem because initially, let me just give you the picture of securitization, and you can't read this, but essentially, here are the borrowers. The borrowers are getting loans from the lenders, and this used to be the whole story. But then what started happening with securitization is the lenders would then sell their loans or transfer their loans to Fannie Mae, which would pool them with other loans. All right, so this is the next step. Instead of just the sale of whole loans, essentially what you did is lenders pooled loans, transferred them to Fannie Mae. Fannie Mae then guaranteed the security based on the pool. This is the mortgage-backed securities. Transferred those securities back. They were then issued to investors, which could be banks, could be individuals, could be hedge funds, could be anything. Turns out Fannie Mae held a lot of them, which is part of the problem. But in any event, so you had the securitization problem. But here's the problem that developed, is you had a principal agent problem in that the lenders who originated the loans, so Chase Bank, didn't hold any of the downside, right? Because they just transferred the loans out. So they didn't, if the loans went bad, typically Chase Bank, and then it turned into, wasn't even Chase Bank, it was mortgage brokers who represented mortgage companies, but they were originating these, and they were originating them to create the mortgage-backed securities, all right? Which then, of course, all of you know, then went on to become the ingredients in CDOs, which led to, basically the entire house of cards falling down. But in any event, going back to this, what you ended up with is a real problem because the lender really couldn't care less about the quality of the loan at a certain point. As long as it could sell it off, Fannie Mae would guarantee the security that it was based upon, and the investors would end up holding the bag. And there was a credit rating agency in there. We all know that the credit rating agency also failed during this period, partly due to conflicts of interest within the credit rating agency. They were paid by the issuers of the securities, and so how can you be entirely objective? Plus, they just didn't have a lot of good information as they pursued this. So, short story long, what ended up happening was you ended up with a big principal agent problem. So, but initially that wasn't a problem with securitization because the only loans that Fannie Mae and Freddie Mac would guarantee, or the only securities, were based upon conforming loans. 80% loan-to-value ratio, really high credit, all right? So these loans weren't going to go bad, so it was safe. But then you started getting into the, you started getting into the subprime problem. And here's where we started seeing things start to fall apart, and that was you started seeing private entities called private label mortgage-backed securities. And what they did was it was private entities came in, and they weren't governed by the same rules as Fannie Mae and Freddie Mac. And what they did was they started buying up loans that were made to people who were less likely to be able to pay back those loans. And you ended up with a whole set of loans that turned out to be very, very risky. And these were typically called subprime loans, although not all. And these loans were characterized, 80% is a very conservative underwriting standard because you've got 20% of equity. So if the borrower ends up getting into trouble, they can eat through 20% of their value on their home in terms of the value can come down by 20%, and you still don't get into the loan, right? So if there has to be a foreclosure, there's still value in the property. But what you were seeing during the 2000s is banks or originators were making loans that were up to 100%, and in some cases even more, because they would lend you money to renovate. So that you not only they give you 100% on the loan, and typically that was done through 2 loans, wasn't only done through 1 loan. They'd give you a loan, and then they'd piggyback another loan onto it. But typically what they did is you had very, very high LTVs. And remember, going back to the option model that we just discussed, they're almost at the point where they're putting the property right from the beginning. One bad thing happens, and there's no value in the property. So you had high LTVs. You also had loans where they were called no-doc loans or no documentation loans. Sometimes they're called Alt-A loans. And what those loans looked like was, I don't want to give my income. I just don't want to give my income when I'm signing up for a loan. Maybe I can't give my income. Maybe I don't have income. Maybe I'm committing fraud. Who knows, okay? Likely a little bit of everything. And they were giving loans to those people. And the way they were giving loans is that they were increasing the interest rate, all right? In addition, you had adjustable rate loans, which were, all of these were typically adjustable rate loans, with high, what they did is to qualify people to buy the loans, or I'm sorry, to qualify people to buy the home, what they would do is they'd give you a teaser rate. So, if the normal interest rate is 6%, they'd give it to you for 4% the first year, and then it would jump way up when it reset. So you had those resets. You also had instances of negative amortization. They had one type of loan which was very interesting, which said you got to determine yourself how much you were going to pay back. And amounts that you didn't pay back got added to principal. So just imagine, if you're already close to 100% loan-to-value ratio and your negative amortization, right? We generally think of loans as positive amortization, meaning you're paying off a little bit every month of the principal. Here you're growing it. And so why were banks doing these crazy things? Why were mortgage companies doing these crazy things? And also, why were people buying homes based upon this? What was the thought process that was going on in this? And I'm going to answer that in a second, but let me just show you how dramatic it was. So these 2 categories, orange and these 2 categories, so this is 2001. Teeny, right? Very little of those mortgages, the subprime and the Alt-A's. By the time you get to 2006, it's a third of the market is these sort of risky loans. And then it gets crammed down all the way to this again after everything falls apart. So the question is, why were people buying them? Well, so one, you had fraud. So what people were doing is they wanted to misstate. They didn't want to support their income. It wasn't just you had mortgage companies engaging in fraud because remember, they make their money by charging fees as they originate the loans. You had appraisers in on this. They were over-appraising property. So that's a piece of what was going on. But really, I would think for the largest proportion of this is you had a culture of home ownership. You got to buy a home. To have the American dream, you've got to buy a home. And we want everyone to buy a home. We don't want it just to be high-income people. We want it to be working people. We want it to be low-income people. And what you had is you had this idea that you needed to buy a home. We made it now available to buy a home. And you might say, well, wouldn't anybody know what was going to happen? Well, there were a couple of things. One is there was this idea that prices were always going to go up, right? It was never going to come down. So what would happen is, because you could say to somebody, what will happen when the reset occurs in 2 years? They'll say, oh, I'll just refinance into a better loan at that point. And indeed, that happened for a while, right? Because the prices kept going up, and then you could refinance and get a new loan based upon the higher value of the property, and maybe get a better loan because you had spent the previous 2 years paying off your loan, so your credit rating went up, and a bank was willing to do that. So that was one of the reasons. Just people, wanted to buy, and I use the word avarice. I mean, I don't know if that's the right word, but they wanted to buy, and they thought that the game of musical chairs would never end. Then there also was a problem. I don't know how many of you have bought a home? Okay, so one. So not unusual. Sometimes there's older students in the room, and there's more people who would have bought a home. When you signed all the documents, it was pretty nightmarish, right? You didn't read them all, probably, even though you went to law school. So the thing is, I mean, you can get documents that are a big stack of documents, and there's lots of fine print, and people really don't know what they're signing in the end. I mean, it is not a good thing. And in addition, people don't process it well. So this article I wrote back in 1993, which was, as I said, my tenure piece, went through a lot of this and talked about how we needed to protect borrowers, how we needed to make non-waivable rules with regard to mortgage foreclosure and protections for borrowers, because we couldn't expect borrowers to be able, number one, to process everything, and because of heuristics that people use in making decisions, we can't expect them to get it right. Indeed, we can pretty much expect people will underestimate the likelihood they're going to run into trouble paying back a loan. So there's all sorts of reasons not to trust people, or at least not to trust the sorts of new borrowers who are coming into the market. You also had lax regulation and political interference, and this was a huge issue with Fannie Mae and Freddie Mac. I mean, they controlled, that's going overboard. They didn't control Congress, they influenced Congress, right? Because they were regulated by Congress. And basically what they did is they made sure that the capital requirements were pretty low. They made sure that the regulations were not so tough. They did a bunch of things that had the effect of increasing the risk to the public fisc. Now, you might say they're private corporations. They can't increase the risk, but they could, and here's the reason. The too big to fail, which we heard over and over again, people were worried about that with regard to Fannie Mae and Freddie Mac 10, 12 years ago. They're huge. People always worried what would happen if there would be a problem. Would the government take over Fannie Mae and Freddie Mac? And basically, the securities for Fannie Mae and Freddie Mac traded as if people believed that the federal government would step in. And that's all they needed. They had low cost of capital. They became humongous. And what they did is, remember I mentioned the quality started going down with these private label mortgage-backed securities? The biggest purchasers of subprime loans became Fannie Mae and Freddie Mac. Because of competition with the private label mortgage-backed security originators, Fannie Mae and Freddie Mac sort of crowded them out of the market. And that's what led to Fannie Mae and Freddie Mac getting into trouble later on, because they bought too many of the crummy loans. They allowed their standards to fall down, and Congress never stepped in to do anything about it. The last element of this story is the softening of the housing market. All right, so you have to have a trigger event. So what caused it all to fail? And I actually was interested in this because I couldn't come up with it. I started calling my friends. I said, okay, so I understand we have a house of cards, just waiting for, I'm mixing metaphors, pull the card out or prick the balloon. So what happened? And so this morning, and I had this view about what happened, that everybody, that people were saying, well, there were expectations, that things were going to go wrong. But it wasn't just expectations. I think that what happened was the Federal Reserve increased interest rates really dramatically. So I looked this morning and I saw that from 2004 to 2006, the Fed funds rate went from 1.25% to 5.25%. That was huge. The discount rate went from 2% to 6.25%. And what you're going to see in the graphs I'm going to show you are you'll see the timing of this. When the market started cratering, it was early. Like, we think of 2008 as when the problem occurred. Foreclosures and defaults and housing prices coming down happened earlier. Starting in about 2006, you can see home prices start to dip down. You can see, here's something dramatic. This is graphing the percentage changes in house values each year. So if you're below 0, it's a negative. If you're above, it's an increase in housing values. The gray line is rent. Normally, you would expect rent and housing values to fluctuate stay together, changes over time. So this looks quite bubblicious, right? I mean, what you end up with is you're having really high in 2006, really high appreciation rates for housing, whereas rentals are staying, pretty flat. So that was when they hit their peak, and then obviously right after that they came down, right at the same time that those rate increases were going through. And you see also that's when mortgage delinquencies are going up, when people are falling behind. And really, that's an incredible graph. And then you can see serious delinquencies. And here's remember I said there's a difference between prime loans, which are the safe loans, the 80% loans made to people who have generally good credit ratings. And then you have the subprime. So what you end up here is these are serious delinquencies, meaning 90 days people haven't paid. You see what's happening. They're both going up. They're both going up, but these started going up faster and more steeply. And now it's affecting everybody. And that's part of the problem with mortgage foreclosure. And I'm going to talk about that in a second. There's neighborhood effects and externalities. Foreclosure rates, look at that. That's huge. I mean, still only about 5% of homes are in foreclosure, but nonetheless, that's a huge number. This is usually really, really tiny. So I'm just going to go back for a second to see if I want to pick up anything. So in any event, nope, that's pretty much, except you all know, Fannie Mae and Freddie Mac got taken over by the federal government. They were insolvent. And the reason was not so much their guarantees, but they ended up being so greedy, they were holding on to their mortgages. So they had a lot of mortgages, subprime mortgages in portfolio, which all went bad, which carried them down. So now they're under federal trusteeship, and basically they are the only entities now. If they didn't exist, we would not be seeing hardly any loans made in the United States because they're being supported by the federal government, any housing loans. So what I want to do is look at 3 questions, and I'm going to only take about another 5 or 10 minutes. I think there's a million interesting legal and policy issues. And this is Chicago's best ideas. So we're all over this. There's a bunch of faculty here who are doing work in various areas. So one question is, what do we do with underwater mortgages now? Now that we're in this mess, what do we do to get out of it? Or do we do anything or let the market work, which of course would be the default answer here. Now, what is the current mess, and may be the right answer, actually. What does the current mess tell us about law and policy of expanding homeownership, and how do we prevent this from happening again? So in 5 minutes, I'll tell you the answer to everything. So the underwater mortgages. The underwater mortgages, I just want to grab some notes. So, of course, the problem with underwater mortgages is the option theory I just described, that basically people at the slightest trigger are going to, those mortgages, there's no reason for those people even to be paying on those mortgages if they want to move or if they have to move. Because basically, those mortgages are underwater. They're never going to get their value back. If they're not afraid about getting sued for personal liability, all they've got is a hit to their credit rating. And that goes away after 5 or 7 years. There's other problems here. So number one, with underwater mortgages, you have an incentive to default. You're also locked in. Let's say you don't want to default, but you can't move, right? Because the value of someone offers you the market price of your house, but it's less than the mortgage. And so you'd have to, if you don't want to default on the mortgage because you don't want to take the hit to your credit rating, or because you think it's immoral to default on obligations, you're stuck. that has macroeconomic effects, right? One of the things that we've seen is in some instances when you have recessions, people will move from one part of the country to the other where jobs are better. It's hard to do that now. If you're in Michigan, it's hard to move. I don't know where you'd go, I guess South Dakota. But the point is, it's hard to move where there's greater opportunity. Also to find housing that's more consistent with your family size. You also have deadweight loss. Mortgage foreclosure is incredibly expensive. You burn up resources in foreclosure. Not only do you have the expenses of doing the foreclosure, but in addition, you have social costs of foreclosure. And this is one of the great things about property. I mean, I think there's a lot of great things about property, but one of the most exciting things about thinking about property debt and property assets is it's not just about you, it's not just in private costs and benefits. There's external, because property is situated in space and that's where the term neighborhood effects come from, right? You have effects on other things in the neighborhood. Mortgage foreclosure has effects on is contagious, has effects on neighbors. Why? One is because if the property is falling apart because no one's maintaining it, that's going to reduce your property value next door, right? It's going to make the neighborhood look bad. Also, if a house next door sells in the market for a low price, that's going to affect the amount you can get for your house. So you have an incentive to maintain your house less well because you're not going to be able to get the benefit of the amount of money you put into the house when you sell it. So you have this neighborhood effect which is spiraling down. And that's why we care. And if you think about all this, this is a vicious cycle, right? You start seeing defaults, you start seeing people maintaining less, you start seeing more defaults, right? And it just balloons. And so that's part of the problem, I think, why this is a big issue of public policy. But the problem, so there's been lots of proposals. How do we deal with this? How do we deal with loan modifications? Well, there's a couple problems here, and one is moral hazard. We don't want other people who can afford to pay their loans but who are underwater, we actually want them to continue paying. And if we make it too easy to modify loans, the worry is everybody is going to all of a sudden try to default so they can modify their loans. And that could have implications not just currently, but that could have implications for the long term. Meaning, it may be that it becomes normative to not pay your debts. Right now, we still have this idea that you take out a loan and you pay it. But if everybody is defaulting and walking away, that's a problem. So one of the problems here is moral hazard throughout all of this. Another is equity. So let's say someone bought a house, didn't take out a mortgage, doing everything right. Someone takes out a huge mortgage and then defaults. Why should that person be helped as compared to the neighbor next door who played by the rules of the game? They both had the values of their property decline, but one gets bought out of the problem through the mortgage modification, the other does not. Also, federal government has come up with voluntary programs. The voluntary programs have typically been about stretching out the payments, about giving 5 years of lower payments. They have been uniquely unsuccessful programs. And you see it in the newspaper and people getting totally reamed in Congress when they go there. And the problem here is, number one, these modifications, you have very high redefault rates. Between 20 and 50% of these loans that are modified, people are redefaulting. So why is that happening? Or why isn't this working? One of the reasons is it's back to the option theory. If there's no value in the property, you're not solving the problem. You're just pushing it down the road. So as long as people are underwater and you stay underwater, just allowing you to be underwater a longer period of time is not going to solve the problem. So the only way these programs are going to work is if you cut principal. And I think people are starting to understand that, but it brings in these problems of moral hazard. You also have incentives of the servicers. So there's the people who are actually doing the collecting and the foreclosing, they get paid one fee. It's very expensive to do a mortgage modification. And in all likelihood, the person's going to default anyway. So you'd rather just go to foreclosure at that point, right? Rather than have all of those expenses. The incentives are not there for the servicer to do this. So Eric Posner of our faculty and Luigi Zingales at the Booth School came up with a proposal, which I think is actually quite interesting. And what they would do is they would have a reduction. Their idea is to mimic, is basically to give a haircut to the mortgagee, meaning the owner of the mortgage, the owner of the debt, to give them a haircut, but to allow them some upside afterwards. And basically to give them, to bring their mortgage down to what it would be based upon the true value of the property, the current value of the property. And the reason why this is so hard is you'd have to have individualized appraisals of every property. But what their insight was that you can take statistics by zip code of changes in property values, estimate what the decline of value for a particular property is, drop the mortgage by that amount to the value, and then say to the lender, okay, we really took away some of your value. We're now going to give you 50% of any upside in the future. And so it's an interesting proposal. They'd probably do this through Chapter 13 bankruptcy, which all of you who are bankruptcy fans know you actually can't change the mortgage currently in Chapter 13. You can change some of the terms, but you can't change the underlying debt in Chapter 13. So that's an interesting proposal. There's other proposals out there. But we really have to address this or we're not going to be able to fix this. Home ownership. All right, this is a huge topic. So I think home ownership, I'm actually, I've done some work on home ownership, I'm a big fan of home ownership. I think it's good for people. I think I think we went too far though. I think we started saying everybody's got to be a homeowner. Renting became, just one step along the way. We have to recognize that some people are always going to be renters, and that it's not a terrible thing. And indeed, it might be the right thing for some people. But I do think homeownership has tremendous benefits. One is wealth accumulation. If you look at most people, what's their most valuable asset? Where are they gaining wealth? It's their home. Among low-income families, 70% of all wealth is in their home. That's before what currently happened. Okay, so that number is going to be way down. Well, it may actually be still as a proportion of wealth, but they're going to lose a lot of that wealth. It matters, though, when you time, right? So it's not always going to be that way. If you ended up buying in 2006, it's not going to be a great investment. On the other hand, over time, home ownership has been a good investment. But timing does matter. Stability. It's good for people to know, right? Rents can go up every year. If you have a 30-year fixed-rate mortgage, you know your housing expenses for the next 30 years. That gives you stability, the ability to plan, at least your most expensive item in your budget. So that's a big advantage to families. And then there's these effects. There's a lot of empirical evidence that shows that kids do better if they're in homeowner families. All right? And this literature started about 7 or 8 years ago. And I scratched my head and I said, what? So you put someone in a house and it matters, same house, a renter, same house, a tenant. I'm sorry, same house, a renter, same house, a homeowner. And the kid is going to do better in terms of education and health by just switching how their parent pays for the home. And we suspected at the time that there was something going on in these studies, and there is. So the most recent studies, which have been done in the past year, are showing what do you think is going on? So there's the empirical. The empirical result is kids do better in home ownership than they do on social and health issues, than they do in rental housing. What's really going on there? Anybody know? Yeah.
If your parents are wealthy enough to own a home, you're probably going to do better.
We're going to control for wealth. So there'll be a regression. We're going to control for wealth, education, race, all those sort of things. But you're close.
Maybe because if you're in a place where people own homes in the community, it's more of a sense of community, and they kind of buy into that, and it's a better social atmosphere.
Okay, that may very well be true, but we can control for that by controlling for neighborhood. So I mean, they're going to control for all these things in this study. What they can't control for, though, are the things they can't control for. And so there is a self-selection. So if you've got the people who are more likely to be homeowners have something that we don't have data on, that we don't have objective indicators that also make them better. I wouldn't say make them better parents, but make them parents who are more likely to take care of these other things. And I think, you know, you can imagine, I mean, if you can put together a down payment, you plan ahead, you're able to really, you're able to get things together. And so so basically what you had is a self-selection in the data. But nonetheless, it is a benefit, but it also is showing you that if we could take those same people and they lived in rental homes, they probably would also do quite well. Social benefits, okay? It is relatively clear that if you live in, that more home ownership leads people to maintain their homes better. I mean, I just use an example. So I'm renting right now. I might put this on the floor after I've drunk from it and leave a little circle, but don't tell the university since I'm in a university building. I would never do that on my own floors. So basically, the idea is you generally have good maintenance, and if I maintain my house really well, I'm going to remember neighborhood effects, everybody's going to benefit. So that is clear. And I've actually done some empirical studies in New York that show high rates of home ownership housing renovation actually does increase property values nearby. And so that's a pretty robust finding. Also, people who are homeowners tend to get more engaged in their community. They tend to vote more. We tend to think that's a good idea. I'll leave off editorializing. But nonetheless, we generally think that's a good idea. The problem with this is it's subject to the same self-selection problem before. The reason that they became homeowners in the first place, they would likely have been good voters, good people engaged in their communities. So what I think we should be doing is leveling the field between renting and homeowning, as well as exploring alternative forms of home ownership. And we have, so Lee Fennell, some of you, anybody had her, how many of you have had her for property? So she has a book called The Unbounded Home. And basically what she's arguing for is a type of tenure in home ownership where what you do is you take part of the risk of home ownership and you have other people invest in that risk, almost like an option. She hasn't worked it out where she has the mechanism yet, but it's the idea. And that might allow people who are lower income to be homeowners, but they lose part of the speculative up and down. And that's something I think people will start thinking about, partnerships, shared appreciation. People who want the risk can have that risk, and the people who want to occupy the homes can sell part of that up and down speculative risk and still have the benefits, most of the benefits, not the speculative benefits, of being in a home. Last issue, where do we go in the future with housing finance? And I don't have answers for a lot of these, but here's what I know. Here's the quandary. Should we prohibit those risky loans altogether? Should we have a legal rule which makes it impossible to borrow that way? Or should we just give information? Okay, this is bread and butter for Chicago, right? So this is the law and economics analysis, right? We tend to like, when we think about law and economics, we tend to like, give people information, trust them to make good decisions. We'd rather have people making decisions on their own than government, big brother making decisions for them. But we got to give them information. And that's the challenge. How do we give them information if we think they systematically make bad decisions? All right? So one suggestion that's come out of the work that Cass Sunstein, who used to be on this faculty, proposed is to have sort of a default option, that you sort of nudge them into a 30-year fixed-rate mortgage and that make it hard for them to move out of that mortgage. That's one possibility. Another is just more information. Another is to have housing counseling. There's a bunch of these different things, but it is a big issue. You want, obviously, to limit systemic risk. So Fannie Mae and Freddie Mac, it's like legally the government did not have to take them over. But we all knew they were going to be taken over if something happened. So we have to have safety and soundness regulations, and they need to be enforced, and they were not being enforced. Credit rating agencies, same story. I mean, we got to deal with those conflicts of interest. And then, interestingly, what should the role of states be? This was, I had two tenure articles. One was this estimate. The other one was looking at who should govern, who should make law with regard to mortgages and to real estate. Typically, it's the states. But what we've seen over the past 20 years is creeping preemption. And indeed, states tried to regulate over the past 10 years subprime mortgages. And the federal government preempted it on behalf of the big financial institutions. So that calls into question a bunch of our presuppositions about at which level of government are private interests more likely to have an impact to gain control of the governing process. So I think this is an open question. We're seeing it right now with all the robo-signings and all these state attorney generals. The action is now taking place at the state level, protecting borrowers, not at the federal level. So we have to rethink preemption. And lastly, what do we do with Fannie and Freddie? That is the big issue right now. The federal government is going to come out with a report in January. My guess is the one thing everybody agrees about, you can't have a public and a private mission together. You somehow, you can't have the situation we had before where you were saying to Fannie Mae, we expect you to be serving the public and yet have private shareholders. Because just a terrible situation, and which led to not all of the problems. There's so much blame to go around, you can't identify who it is. But this is one instance. So I spent I spent sort of 25 years teaching about real estate, and little did I know, no one cared about most of the things I was writing for most of that period. Real estate sunk the economy, and so we got to care. With that, we got some time for questions. I went too long, but so we'll take 10 or 15 minutes of questions. Who's going to be the first? Come on. Yep.
How much are these new approaches to sharing risk on houses? What Professor Fennell and Professor Posner suggested. How much are they going to be just as subject to sort of the problems that homeowners had with concepts just like balloon payments and negative amortization? How are they going to handle like an options market where you can sell off part of the risk, part of the upside and downside of a house? How are they going to handle the financial decision making when they clearly couldn't handle, much more basic financial, questions such as like increasing interest rates?
I think that's a great question. It's coming back to the question that I asked. Just a normal mortgage, how are we going to get that information out? How do you take these hybrid models of tenure? How do you take a homeownership model, break it down into different things, and expect people to be able to make those decisions? I think that certainly at the beginning, you'll have people who actually know what they're doing because these will be so exotic, and then over time, I think that the only way to do it is to perhaps again have some form of federal subsidy, or somehow have Fannie Mae and Freddie Mac try to go out and, if we still have a Fannie Mae and Freddie Mac, and market these things to people. Because what's going to happen is, for low-income families, it's going to be hard to see how we get mortgage products out there anymore. And so this may be the only game in town for those folks. And so that may be, for those folks, the way that they end up doing it. I mean, we really, the dust is really not clear. And I don't have a good answer for your question, because I think what you've done is, it's almost a rhetorical question, which is, it seems very, and we haven't seen, so what I can suggest to you, which suggests to you it won't happen, is Andrew Kaplan, who is a former colleague of mine at NYU, had this book called Housing Partnerships, where he proposes something like you set up a limited partnership with investors to achieve the same sort of thing. They take the upside and the downside. You take the safe return. And he thought he was going to make tons of money on this. So I shouldn't get into it, what he did. But nonetheless, it wasn't anything bad, but it wasn't great either. Nobody went ahead with that, and that was like 10 years ago. And they thought they were keeping it secret. Goldman was going to run with it and stuff like that. It's, people tend to default back to what they're comfortable with in this area. Yeah.
It seems to me that when you talk about solutions for the underwater mortgages, you focus on focused on solutions from the lender angle, and you talk about moral hazard and equity when you compare lenders to people who buy. And what's interesting to me about the Posner solution is that it focuses on you're focusing on the borrower. And I'm saying, what about the lender? Like, you know, you focus on the borrower and borrowers versus homeowners. What about the lenders? And I guess the problem is that aren't there similar sort of moral hazards if you're helping out the lenders, but at least you don't have an equity problem because there is no lender in the situation of, you know, not that I think a lender-based solution is politically feasible because it's essentially pouring money into the, you know.
But I don't understand, you know, the lender, essentially what Posner would do would be to say to the lender, it's not really helping them, it's saying, here's where you would be, you really don't have, so let's say the house, the mortgage is for $500,000 and the house is now worth $400,000. It's basically saying, you've got a mortgage for $400,000 now, which in reality, they have a mortgage for $400,000. They don't have a $500,000 value. So it's really just, they're trying to get to a point where they treat the lender, they don't hurt the lender, they try to treat the lender put them in the same position they are now, but get rid of all the transactions costs. So their assumption is the lenders would volunteer, this would be Pareto superior, they would go to that model if they could, but instead they've got transactions costs in the way. So they're trying to eliminate the transactions cost and to sweeten the pot, because of course that lender would get some upside if the market came back up. They give them 50% of the upside, which no one knows when the market's coming up.
Moral hazard there too. I mean,
what's the moral hazard that you're thinking of?
I just foresee that if you're essentially helping the lenders out, at some point they may come to rely on that too. It sort of increases their incentive to it. I mean, I guess they're taking a hit.
But I don't think you're helping them out. Oh, well, I think, so what you're doing is, I don't think you're helping them out in the sense that you don't make them go through foreclosure. But typically what's going to happen is the borrower is going to stay in that home at that point. So you're really not helping them in a major way. I mean, I don't think it would have effects going forward other than thinking that if they do stupid things in the future, like they did in the past, government will come in some way and try to fix it. I think they're going to be taking losses, and so, I mean, typically the way we deal with moral hazard, right, is through deductibles and coinsurance, right, is to typically make someone take a part of the hit, and in essence, that they're having to do this. They would have had to do it anyway if they foreclosed. They're just getting it right away.
Two kind of related questions. Do you know what the percentages of defaults that are strategic? That are strategic. And second, the states like California that don't allow mortgage lenders to go after your other property see higher rates of strategic default. So do you see them following suit of the states that allow mortgage lenders to go after your other property to try to cut down on that?
So that's interesting. So I don't know the percentage that are strategic defaults. I do know there is a percentage. I just don't have it in my head. I don't think it's super high, but we got plenty of time before that happens. I mean, the other way out of this, quite honestly, is that the market saves everybody. And I think that's what everybody was hoping for over the past year. That all we needed was a pause, a moratorium, stretch out the payments, and housing always comes back, right? It's cyclical. It always comes up and down. It's just the bad news is still coming in housing to a certain extent, and so it's not coming back anytime soon. So the answer to the first question is I don't think it's a huge proportion that's strategic, although it depends on how you define strategic. Presumably you define strategic as being you could stay there, you had the money to stay there, but you default just to get rid of this albatross around your neck. I think that for all the reasons we just suggest, it's probably not something that happened. Ruthless default, it happens, but it doesn't happen a lot just because people don't like to take this huge credit rating. Now, I predict it will happen more and more as people see it's okay to do that and as everybody else has bad credit ratings, as a result of this. So I think that it's a problem that will become greater. Now, it's a really interesting question. Will states change their laws to permit, so in California, if you get the predominant form of home loan, which is a deed of trust, you can't go after the borrower. So what they do is they give you a fast way to foreclose, which is still not fast, and they say, but you can't go after the borrower for the deficiency judgment. Whereas in New York, you have to go to a judge. Takes forever, but you can go after the person for liability. I have my doubts if anyone's going, they say they're going after liability. I can't believe that many people are going after personal liability. And given that, I think there's just not a whole lot of blood in those stones, that it's not clear to me there's going to be a big incentive in California to switch to a New York law. Where I think the legal change is going to occur is all the stuff you're reading about right now. I mean, what you see is, just a lot of mortgagees, meaning lenders or whoever's holding the mortgage loan, not following all of the legal procedures required. And I think people need to, what I'd be doing is it would cause me to do two things. One is try to step up enforcement where it matters, but also look and see, are some of those legal procedures necessary? Because I think what a lot of people think is going to be happening is this is just going to postpone the inevitable. That, if you didn't sign, if it wasn't signed by the right person, they'll just get it signed by the right person, and it will slow things down. But it's just, I think it's not even clear the advocacy community is that much fully engaged in this. I think there's some problems that potentially could invalidate the mortgage, at least in some states. But you're going to get a whole set of different rules at the various state levels governing this, which it'll be interesting to watch it as it goes. But I don't think you're going to see everybody moving to take the New York law of mortgages. Yeah.
I mean, I know one big part of this problem is on the lender side. They say, they're giving these subprime loans, but on the flip side, people are taking these loans out. And, does a state like New York, even though they may not go after borrowers in deficiency judgments, but states where you're still liable on the note, is there an incentive, excuse me, for borrowers to be a little more aware of the risk? That it's not just, I could lose my home, but as long as I can just keep getting home equity line of credits, that's all that's in the pot, really. Does the potential for a deficiency judgment?
I think it matters. No, I truly think it matters on the strategic default side. I think if you have a trigger event, you may not have a choice if you're unemployed or you have a health problem, you just don't have the money. On the other hand, for the people who are doing it strategically, meaning they just sort of say, why should I stay here? I should just rent at this point. I could rent the same house down the street for cheaper than here, and I'm never going to have the value. Having that possible threat out there, and indeed, I think banks will start making examples, or should be making examples. Part of the problem is a lot of these loans are going to be held by the federal government through Fannie Mae and Freddie Mac, and politically that won't be such a great thing, is to be going out, when someone's down on the ground, then you step on them. I think it'll be hard to make those examples, but I think if it were all in the private sector, I think that they would try to make some examples, publicize that so people would care about that, and I think people do. I think still, now we're not far along in this, unfortunately, but people still feel they make a loan, they should repay it, even if there wasn't legal liability. So I think that we have a ways to go. And certainly, and I think actually in California, a state, people still feel that they should repay their loans, even though they know the lender can't come after them. So I still think that exists. Other questions? Yeah. So I guess we should this should be the last one, do you think? Okay. Go ahead. Make it really good.
Yeah,
no pressure.
Institutional explanations and kind of just things that are occurrences. I like to blame people for stuff. So I was wondering, is there any people that we can really point to say, they caused this person caused this? You mentioned the Federal Reserve, but I was wondering if there's...
Yeah, blame all of us. Basically we made home ownership, we made buying. What we did is we changed shelter one of the basic human needs into fun, right? We changed the house from the place that we bring up our families in to an ATM machine. We basically fully marketized not fully, but we marketized the house, and we encouraged, public policy encouraged people to borrow as much as they could and secure it with their homes. And that was clear in '86. We said, okay, student loans, not deductible. Credit card debt, not deductible. Home loans, deductible. And even better, if you fix up your home, you then get to, or if your home goes up in value and you buy a boat, if you take a mortgage out, a home equity line of credit, you can use tax-deductible debt to buy the boat or go on vacation. And people did that, right? And that was Congress, right? That was all of us, in some ways. So basically, but there's also a lot of bad people, right? There's us. So that's the easy answer, all of us. But then you pick it through. You have people who defrauded people. You had a lot of mortgage originators and mortgage banks. But does it do us any good to say you're at fault? They're out of business. They're thinly capitalized. They're gone, gone, gone. Some of them might be in jail. Countrywide, right, he just had to give, $60 million? They were Countrywide 10 years ago, 15 years ago. I wanted to invite Angelo Mazzillo to be the keynote speaker at a conference I did. Why? He was the hero because he was creating homeownership for the masses, right? And that's one of the reasons why this is hard, because there was some good done. It's just the excesses it just got out of control, and everybody was in on the party. And so it really became very problematic. But then when you think about all of this, when I think about all of this, and I think about rules and regulations, the big problem for a lot of our history in mortgage lending is credit allocation, that it was too hard to get loans. And then all of a sudden, it became too easy to get loans. And that, we have to get that balance back. But there's lots more bad people out there. And then there's some good people. I'll have to figure out who they are, though. All right, thank you very much.